I see the Dow Jones Industrial Average getting down maybe another 15% by the end of 2010. The reason is for fundamental reasons. People are curtailing their spending. People have run out of credit. Inflation is taking its toll. Now taxes are going to go up. There's talks of a value-added tax. All these taxes and increased inflation are going to cause people to spend less, which means corporate America is going to get hit hard. Their bottom line is going to come down, which means stock values are going to come down. I see by the end of this year, the stock market down another 15%. By the time this economic cycle is over, the Dow will more than likely be in the 2,000 to 4,000 range before it bottoms out.
Wow. And your forecast on the bond market?
Bond market is absolutely horrible, not a good investment. And a lot of times what investment advisors will tell you is when stocks are doing poorly, go into bonds. When bonds are doing poorly, go into stocks. No, they're both coming down right now for fundamental reasons because of decreasing revenue. The propensity to pay off your debt holders, which is a bondholder, is down. That's going to cause your stocks to come down. That's going to cause bonds to come down. But from a pure economic perspective, how does the bond market operate? As interest rates go down, the value of bonds goes up. That's why the bond market has been such a phenomenal investment category for the 80s and 90s, because interest rates came down from the early 80s from the 15 to 20% level to where it is right now at some of the lowest points in the history of our country. So where can interest rates go from here? They can only go up. And as interest rates go up, the value of bonds comes down. The bond market is going to be the next bubble that bursts in this economy. And the scary thing about that is that the bond market is way bigger than the stock market. The implications are much more massive to insurance companies, to pension funds, which have forced allocation into the bond market. You don't want to have forced allocation into an asset class that's going to come crashing down. That will have devastating effects on the economy.